The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
In just 2 years, American families lost over $8 trillion in wealth.
1 million homeowners are in danger of losing their homes.
And most of them had no idea it was coming.
The U.S. economy likely not going to start recovering till the end of next year.
Imagine it's 2005. You're sitting at the kitchen table with a real estate agent. There's paperwork everywhere. The agent smiles and says something that millions of Americans heard during that time. Don't worry about the price. Housing always goes up. And honestly, it felt true. Your neighbors just sold their house for almost double what they paid. Your co-worker bought a second home as an investment. Banks were approving mortgages faster than people could fill out the paperwork. Buying a house didn't just feel safe, it felt like the smartest financial decision you could make. But within 3 years, that same decision would wipe out trillions of dollars in wealth, destroy millions of jobs, and push entire neighborhoods into foreclosure. This is the story of how the 2008 housing crisis wiped out middle-class America.
2008 was a tumultuous year for the economy.
For most of the 20th century, the American middle class followed a simple formula. Go to school, get a stable job, buy a house. That house wasn't just a place to live, it was a financial engine. Every year, its value would climb a little higher, and by the time you retired, it would become your biggest asset. For decades, this system actually worked. But in the late 1990s and early 2000s, something changed. Housing prices didn't just rise, they exploded. Between 1997 and 2006, home prices in the United States increased by 127%. Suddenly, people weren't just buying homes to live in, they were buying homes to get rich. But here's the part most people didn't think about. What if that financial engine didn't behave the way you expected? Because homes can rise in value, but they can also stall or even fall. And most importantly, a house only works as a financial plan if time is on your side. But life doesn't always follow timelines, does it? Unexpected events doesn't wait for the market to recover. They don't wait for the equity to build. And that's where relying on one asset becomes risky. For some families, the real foundation wasn't just what they owned. It was what protected them. Products like Family Protector 2 were specifically designed with that idea in mind. Not to replace assets like a home, but to make sure that no matter what happens, the family itself remains financially secure. Because while markets fluctuate, protection shouldn't. Get yourself a Family Protector Life 2 from iCover.com in just 5 minutes from the comfort of your home and protect your family today. By the early 2000s, America had entered what looked like a housing gold rush. Construction companies couldn't build houses fast enough. Investors were flipping homes like stocks. And ordinary families started treating houses like ATM machines. Here's how it worked. Your home price rises, so you refinance the mortgage and borrow against the new value. That money pays for a car, maybe a renovation, maybe even another property. And as long as housing prices kept rising, the system kept working. But there was one problem. Underneath all that optimism, the financial system was quietly filling up the extremely risky mortgages. Banks had discovered something powerful. They could make huge profits by lending money to people who normally wouldn't qualify for mortgages. These loans were called subprime mortgages, and they often came with a tempting structure. For the first couple of years, the interest rate was extremely low, so the monthly payment looked manageable. But hidden inside the contract was a trap. After a few years, the rate would reset, and suddenly the monthly payment could jump hundreds of dollars overnight. Now, normally, banks would never take that kind of risk, but they had figured out a clever workaround. They weren't planning to keep these mortgages, they were selling them. Banks started bundling thousands of mortgages together and turning them into financial products called mortgage-backed securities. Then they sold these products to investors around the world. Pension funds, insurance companies, investment banks, everyone wanted a piece of America's housing boom. By 2007, trillions of dollars in mortgages had been turned into complex financial assets and sold across the global financial system. Which meant one thing: if American homeowners stopped paying their mortgages, the entire financial system could collapse. And then something happened that almost nobody expected. Housing prices stopped rising. At first, it didn't seem like a big deal. Markets go up and down. But the housing boom wasn't built to handle a slowdown. It was built on the assumption that prices would always go up. Once prices stopped rising, millions of homeowners found themselves in trouble because many of them owed more on their mortgage than their house was worth. This is called negative equity. And once that happens, the math of homeownership stops working. One by one, homeowners began to default. Maybe they lost a job. Maybe their mortgage payments suddenly doubled. Maybe they just realized they were trapped in a house worth far less than the loan. By 2008, foreclosure filings in the United States had exploded to over 2.3 million homes in a single year. Entire neighborhoods began to change. Homes sat empty. Property values collapsed. And the middle class began losing the asset they depended on the most: their homes. The housing crash triggered something even worse: a chain reaction across the entire economy. Stock markets plunged, banks failed, retirement savings evaporated. In total, Americans lost over $8 trillion in wealth during the crisis. But the damage wasn't even distributed. Wealthy investors had diversified assets, the middle class did not. For most families, their home represented the majority of their wealth. So when housing collapsed, the entire financial foundation collapsed with it. As housing collapsed, the economy followed. Construction jobs vanished, banks stopped lending, businesses cut spending, unemployment doubled. Millions of Americans lost both their homes and their jobs. And suddenly, the housing crisis was no longer just a real estate problem. It had become the worst economic crisis since the Great Depression. The 2008 housing crisis revealed something uncomfortable about the American dream. For decades, the middle class believed some ownership guaranteed financial security. But when an entire society builds its wealth around a single asset, that system becomes fragile. Homes were supposed to protect families. Instead, they became the trigger for one of the largest wealth destructions in modern history. And the people who paid the biggest price weren't the banks. They were the millions of ordinary families who believed they were doing everything right.